Let's start with what are the trading strategies that you should focus, what are the trading strategies you should really ignore. Let's start with the foundation first. Okay, first to start with, all the retail traders, if you are trading retail, if you can type what strategy you use right now or what strategies you tried so far in the question section so that I can understand, I can expand a little bit more. So go to the question section, type the strategies. It could be like supply and demand, it could be like a volume profile, it could be like a VWAP bounce, you can feel like a breakout strategies or like anything. Type it in there so that I know. But the problem is, what are the strategies that you're using? You can go back and search. It should have been like introduced and are like developed like years ago, not even years ago, decades ago. But the thing, the market is changes so rapidly right now. It's those strategies doesn't really work at all because uh, my institution algorithms know the pattern of the majority of retail traders trade, so they do counteract those trades. They trade against you. That's why it's not really wise to spend time on learning those outdated still strategies that stopped working years ago. Okay, so the reason why I'm saying is that those retail decades old strategies are the real reason behind all your blown accounts, lost savings, and endless frustration. Okay, so more and more you spend time on those very old trading, you're gonna get frustrated because it'll work sometimes. It'll work like one or two times when, like people say, when the market is trending, as long as you take a long trade, high probability you're going to make money. But we don't know when the trending is stopping. We don't know when this trend is stopped. We don't know when the trend is going to reverse. We don't know when the market is going to go sideways. So that's a luck factor. But for us, if you wanted to really want to succeed, you should stop first trading with decades old any strategies. You can find the documentation. You can find any videos like 10 years back or 20 years back. You got to stop because those doesn't work anymore. Okay, again, the reason I said is that market is changing every single day. More and more institutions are researching and developing new ways to trade, new ways to draw you, the retail trader, in the wrong side of the market, wrong price level, so that they can take your trade. That's the whole objective. Because that's one particular topic I don't want to get into. It's very um, um, controversial, which is institutional traders are going after your stop, or institutional traders are go against your trade. That topic, I have seen proof. I will show you proof of how traders are designed to get manipulated, are designed to use the strategy so that they can leverage your trade, your stop, your targets. Okay, so I have seen that time and time again. Now we have developed completely opposite of retail trading. The same way institutions see your majority of traders, how would they trade? We take the opposite stance. I can show you tons of examples on those things. Okay, so don't get your trader stop get be hunted or exploited. Okay, that's the main reason I wanted to bring it here. But okay, so let's go back to the institutional strategies. um, Institutional strategies do not trade the same any of the strategies. Whatever you trade on volume profile or footprint or like a wave up doesn't really matter, right? So what are the strategies you choose, they are not going to trade because that stopped working. Also, large institutions aware and know for sure whatever worked yesterday will not work tomorrow, because there is another large institution doing research and development on how to exploit what's working now to take the opposite side of the trade. So they always the highest um, speed in terms of research and development of taking the finding the opportunities, exploiting the opportunities. That is why they invest more heavily in technology, heavily in talent, heavily in research to find their alpha returns. That's why if you go to I'm not sure how many of you know the large institution. I've been worked in Bank of America trading floor. None of them trade manually, so that I can tell you. The largest trading floor for Bank of America is in Charlotte. I did work on the floor. Nobody trade manually. Okay, that I can tell you one thing for sure. So, but retail traders are, by the time you saw the price action, by the time you see the setup, by the time you enter the trade, they already entered and exited. A lot of things happen. They are that fast. Okay, and also large institution was able to do this kind of research because they have army of data scientists to research in depth about how the market is changing, what are the opportunities, how they can keep on improving and finding new and new strategies or DGs every single day. Okay, they are trading every single day, but you and I are traders trading 20, 30-year-old strategies and still thinking it might work. I feel like that's like betting on the dead horse and hoping to it can win the race, come first. That's impossible. It's never going to happen. Okay, that's why one thing I can tell you is that all the algorithms, all the institutional algorithms, all the automated algorithms, market makers or hedge funds, everything is based on the data of level two market depth and order flow. They look at a whole market auction process, how the shift is happening, why is the balance is happening. When there is a big move, they know what price level, what quantity, what kind of pressure we're going to get, how to balance those, how to spread the orders. They know exactly. So that's why you need to focus more on what's happening right now, what's working right now. Okay, so that's why. But I wanted to tell me one thing. Even I'm going to talk about institutional strategies. It will be impossible for you to learn or even know all the latest institutional algorithms, strategies, because by the time they publish a white paper, research paper, they already moved on to the next different strategies. They operate at lightning speed, um, so they keep on improving. That's why it's impossible for you to, when somebody says like institutional strategy, but yeah, but they already changed, they already moved on. But the good news is that there are some institutional strategies using the same data that they use, like level two market depth and liquidity, still um, working. Because the reason is we have backtested, we have tested, we have executed those trades. You can see all the live examples in our YouTube channel. Also, if you go to our YouTube channel, we even posted the live tradings as well. Okay, the point is you got to use at least one or two institutional strategy, not looking at the price action. That is the most important factor, because that's why we handpicked some of the strategies the same way they trade. And also the challenge was the more advanced strategy is more complicated to learn, more complex to execute. So the challenge for us to, when we are a year or 2 years back, when we wanted to introduce those strategies to retail traders, our challenge is not bringing the trading strategy or plan. Our challenge was to how to simplify it so that it's we can explain, we can help retailers understand what it is and how to execute, because the knowledge transfer from us to retailers to educate you, help you to learn those strategies, that is the hardest, because again, more complexities is more hard to execute. That's why we had to work almost a year plus to simplify those. And also we have to develop a tools around it so that it can help you to read better than looking at the naked charts or look at the naked numbers. So we did look at that's why we have to focus on those things. So again, first you need to stop focusing on historical price movements or like historical chart patterns, or like anytime you see deciding based on historical price movements, that's when you get really loose. You have to start focusing to read the level 2 market depth, institutional liquidity, because when the market is moving faster, the only reason is the market order flow is shifting. How it's shifting, where it is shifting, which price level is safer to enter. You need to know all those things. To give a little bit of background, when you look at the chart with the price movements, all it says is how the price moved in the past. Okay, so even though there's a pattern to it, how the price moved in the past does not guarantee you how it will move next. That is the biggest problem, because historical chart is just past. But if you look at the actual level 2 data, you by default, how many of you have level 2 data in market data in your trading platform? because most of the retail traders don't even have the level 2 upgraded data feed. The reason is they don't have level 2 because they don't know how to read it. They don't know how to use the data, they don't know how to read the information. And more than that, they won't know how to find the opportunities in those level 2. That's what we're going to talk about today. Okay, the reason I'm talking about is this is when the market is active, that means orders are going to exchange continuously, sellers and buyers. It's like market live auction process. Like the exchange is just matching the orders to the buyers versus sellers. The real live action market auction process. But that's why I had to underline price action versus the market auction, because market auction, if you understand how the market auction works, which side is more control, which side is more aggressive, and the shift happens, that's when you'll find the opportunities. But for us, this is very hard to understand because these numbers will be keep on changing really fast. To compare, to give a perspective about why you should stop trading the historical charts, looking at the price and everything, you should start looking at the current market auction level 2 data. Think like you're going to drive the car forward by looking at the rear view mirror. It's never going to work. If you wanted to look fast, you can look at the peak, how it went through everything. I'm not saying, but you have to focus on the forward, what's happening right now in the exchange, how many orders coming in, and how fast it's coming in. Out of the orders, how many are the buy orders versus the sell orders? What is the frequency of the speed increase, or it's like a speed? You got to look at all those factors in to understand what's happening in the market right now. So that's when we started. That's where we started in terms of these level 2 screens that we have, either the super dominant NinjaTrader or like a level 2 screens. The numbers keep on, doesn't really help at all to visualize. And then there's a book map and then other tools. They are just converting those numbers into the visual form of painting colors. That doesn't give you anything because they're painting all those numbers by color coded. That's it. They are not really separating the noise versus the signal ratio. That's why we had to focus on, okay, so first focus is how can we take those level 2 information, market data information, market depth information, instead of painting everything on the book map like a visual tool. We want to see how can we reduce the noise of the orders, the liquidity that didn't matter. What are the orders and then level 2 market depth? It really matters for us to take a look and then start looking for the pattern. That's why we decided to develop the liquidity indicator to separate the signal versus noise and focused only on the strong and persistent liquidity. That's our product. Primarily, this is where the tool we're going to use going forward with all the strategies. I can walk you through why this is very important, because using BST liquidity zones indicator on NinjaTrader, we look at the market depth, but ignore all the noises, only detect the institutional high quality liquidity that does not change, fluctuate, or like thinning out, something like that. Like it has to be persistent, constant. So with that, once we are able to increase, then we'll be able to look at how the market is shifting. Okay, are you guys with me so far? If you guys with me so far, if you have, hopefully I'm not adding more complexity to it right now. Type yes if you're able to understand. If you have any question, please type it there, because I'm going to show you the next screens on how to see the market action process in a different perspective outside the price action, because that's the most important part. That's the most exciting part, because all this time, I'm pretty sure you guys were trading based on the price, historical price movement. I'm going to hide the price. I'm going to hide the price, and then I'm going to show you how the shifting of market auction process would look like. That will be like a game changer if you're able to understand those things. Again, I'm going to show you a few things. Don't worry if you don't understand. More and more you spend time analyzing those information, you'll get better. Okay, so let's take a look. So I think let's start with, how about let's start with today's chart. Today's chart. How many of you traded today? How many of you traded today? Futures, ES, NQ, doesn't really matter. How many of you traded today? If you noticed, I'm on Central Time, Chicago time. So for me, from 9:10 around, the market started like trending up. It trending up almost like 9:10 to like a 12:10, almost like 3 hours. Market was continuously trending. How many of you traded during those times? Say me, or like I did not trade. I didn't even look at it. Something. Even if you traded SPY or options, anything, it's still I consider this as a futures trading on the S&P market. The reason I'm showing is that even though market is trending here, which is the safest place to enter? Which is a better confirmation for you to enter? Yes, you can say the pullback is a great way to enter, right? So a lot of the time we say like pullbacks is the greatest way to enter. But the problem is that you can tell the price moves like this is high, lower, higher highs and higher lows. But once it goes to certain place, it started forming the opposite side of the market, like lower lows and lower high. You think um, this is a pullback, and then you enter the long here, because once you go here, you see another pullback, you enter long. What will happen? The price come down, take your stop. But if you look at liquidity that I'm going to show you next, you will know exactly you won't take the trade here, you will take the trade here. Same way, you won't take the trade here, you will take the trade here, you will take the trade here. By looking at this chart, there is no way for you to know these are the ideal places to take a trade. Okay, now let me try to shift the gear and show you how you can look at the same price movement through liquidity. When I say liquidity, auction process, right? So this is what we see. Intentionally, I did hide the price so that I wanted to look at only the institutional liquidity. Anytime you see the green lines, is nothing but, if you go back to the earlier one, the green line is nothing but the strongest bids. Strongest bids, like institutions are entering the limit orders. That means if you see a strongest green line, that means at that price level, we have so much of buying interest. They have a pending limit orders sitting in the market, sitting in the exchange, so that when the price come to that level, they're ready to buy more. They're ready to buy more. The opposite is true. When you see a strong red line, that's nothing but the strongest ask. You can see some 63, 249, 289. That means at those price levels, there are sellers are ready to sell. They are having a limit orders sitting in the market. So when the price comes to that level, they're ready to sell. That's what it literally means. So now by looking at this market, if you don't look at the price movements, just looking at the liquidity, you can see buyers were here, okay, and then they shifted. They started to buy at higher price, and then they wanted to buy at higher price and higher price. We call that as a ladder approach. That means price moves like ladder. Okay, and then look at right here. This is the most important part. Once the buyer is, once it reaches here, they are not increasing their bids. They are stopped. That means the market is going sideways. That's when we say this is the most highest clarity way to see what is the step. Because when we see that this gap, do you see this gap? This gap is a volatility range. That means anytime the price is here, anytime the price is here, I don't really take a trade. I don't even look at it. Because why? Because it can come back to the floor and then move up. This is why the floor is very, very important. We want to look at when the price comes to the floor and then turn. Anytime it comes to the floor and then turn, that's the best opportunity for us to take a trade. That's why we look for. Anytime, even though it's like creating that higher highs, higher lows, beautifully with all the chart patterns, all the VWAP, everything, we don't take a trade. We wanted to take a trade. What is the best price the institutions are willing to buy? Not retail. You need to buy the institutional price where large institutions are ready to buy. Okay, now, are you guys with me so far? Okay, so type yes or no in the chat so that I know you guys. So right now, like I said, when the price moves uptrending, we focus on those price liquidity levels where the large institution are willing to buy. Why? When the price come to that level and they start pushing, that means they are buying. But the intent the price coming down, it starts turning going up. That means they are buying more. Then I will buy more. You should buy more. Now if you understand it, let me go back and show you with the price movement now. Are you guys ready so far? Now take a look now. Now I have the liquidity zones indicator. Now every time the price moves, I don't buy. We'll wait till price come back to that level where institution ready to buy. Okay, look at those things. Anytime they go, this is where. Okay, again same thing. And then when the market is like going sideways, you can see buyers stayed here, sellers stayed here. That means buyers don't want reluctant to increase their bids. Unless I don't see the lines moving up, I'm not going to move my stop, because that's where buying based on the ladder, well, not the ladder, what do you say, like stairs approach. Like every time the price moves, buyers liquidity, institutional liquidity, they are moving up, they move up. Once they move up, I can move up as well. This is why if you start ignoring the manipulation price action, purely look at the liquidity standpoint, look at where the institutions are buying, where the institutions are selling, that is going to change your trading a lot. Okay, so now we talked about the uptrending. So any guess on to see how the opposite side look like? One of the person is asking how to show the same thing live market. Go to YouTube channel. We recorded a lot of trades in live market in the same indicator, everything. You will find a lot of live trades recorded in our YouTube channel. All right, so let's go back. Now let's look at the opposite side of the market. When the market is like trending down, one thing I want you to take a look is when the market opened, I want you to take a look where the market was sideways, and then market starts shifting down. You know, a lot of traders lose money here because the price action here really confusing. Sometimes they think it's a long, it's not a long. They think it's a short, it's not a short. They need to wait for the perfect breakout. Here's the thing. I think one of the attendee mentioned they trade breakout. I bet when you say you trade breakout, you're trading the price action breakout, right? We trade different. We trade liquidity breakout. Okay, let me show you. What do I mean the liquidity breakout. So, all right. So now, same way, I did turn off the price movement. I just focus on liquidity right now. One thing you can start looking now on the downtrend, we focus on ceiling. That means anytime now sellers are moving that buy, this is where they are ready to buy at this point in time. Now this is where they are ready to sell. That means you are looking at the opposite ceiling side. Anytime the price go back from here and goes down, we sell. Anytime we go down, we sell here. Anytime we go down, it's opposite side. When the market is trending up, we look at the floor, the green liquidity floor. When the market is trending down, we look at the red liquidity ceilings. Anytime the price goes to that level where the institutions are ready to sell, I want to sell at the same price level or very close to it. Okay, now let's look at the same thing in terms of with the price action. Okay, I want you to watch something very important. Have you ever noticed, like, let me give an example. Let's say there is a fruit vendor. Say, I have the last 100. I have the last 100 fruits right here. I'll give it to you best price. Here, whoever gets it the best price. Let's say you go and buy all the 100 fruits right there, and then moment you turn back, they pull another 100 fruits and start selling again. That's what happens here. They are ready to sell, right? And the price goes back up. They were able to sell those contracts. Price goes down, they add more contract to sell. Price goes there, they are able to sell. Price goes down, they're able to sell more. What does it say? It says something they are very much interested in selling more and more contracts at this level. If you have that much selling interest right here, would you think the price is going to move up? Absolutely not. It's a market auction process. Somebody is selling thousands of contracts. Again, they're adding more and more, adding more and more. That means the selling pressure is, you can literally see, because once they're able to sell those contracts, they're refilling the order with same price about more and more sell contracts. Okay, so we talked about price breakout. Look at the breakouts here. So if you look at the breakout, this is the sellers are interested to sell. This is the buyers are interested to buy right now, going ways. Moment we see right here, the green lines are not moving up. The buyers are not moving up, but sellers, they're shifting down, shifting down. But once we can see the same control was shifted, where a lot of buyers were there, now the sellers were there. This is where the perfect very first entry is like a great place to enter. The reason is, moment we can see the shift happens from buyers to sellers. This is where you can very close to the buyers. Short, again, price back, go back to the close. Institutions are ready to sell at this price, so we can take, I can add the contract. You can really see every time the price goes to back that level, those are the opportunities for you to add contracts or enter a short trade. Okay, so that's why don't trade the price action based breakout, trade liquidity breakout. When I say liquidity breakout, when the liquidity from the institution's shop start shifting from strongest buying interest right here, strongest buying interest shifting to strongest selling interest, that is a true breakout. That is a true breakout. You should enter and then wait for better timing. That means price will go back to that level. They will sell more to push it down. You enter along with them. So on first end, you might be hearing this kind of strategies, institutional strategies. The more and more you watch your charts, that's why we say like 100 days. The reason is that when you watch a chart, you start seeing liquidity, practice those trades, practice anticipating more and more actions like this, you will know what to expect, how it's going to behave, when can you enter. Okay, so now let's same thing. Now let's look at we looked at the raw price, how the liquidity looks like ceilings, and then goes. Okay, now you should really ask me, Rob, you showed me how the market is trending, how the market is downtrending, but most of the time the market goes sideways. Most of the time we get chopped on a sideways market. How does the liquidity shows the opportunities or trading look like on a choppy day? Here's the thing. The good trading strategy not only help you to find the good entries to trade and direction, also the good trading strategy should help you to stay away from the trade when there is no good trading opportunities. Because it may suffer. Understand this. A good strategy not only help you to stay enter the good trades, also it should help you to force you to stay away from the trades when there are no opportunities. Okay, if you understand what I said, let me show you what do I mean by that. So this is like 16. The market was like, you can tell, but between like a 10:30 to almost like until the close of the market, all day after like 10 o'clock, market been sideways, But there are a lot of manipulations. Like moment you see, oh, it's higher highs and higher lows, if shifting lower, I'm going to take a short trade. No, I think that's when you will get you get stopped out. Let me show you same sideways market, how it look like on a liquidity. Okay, if you look at it right here, again, intentionally I'm hiding the price action so that you look only the liquidity. So if you look at right now, where is it? The strongest buying interest stayed hold here, and then strongest selling interest stayed right here, right? These are the edge, we call this edge liquidity. Okay, that means if at all there is a trade, long trade or short, let's say if there's a long trade is coming up, then you should start seeing these green lines should move up and then take over the control from sellers. It should see the green lines here. That is a true breakout on the liquidity. On the opposite side, if you wanted to see The short trade, you wanted to see, you see these lines, it should move down all the way to the edge and then see the taking of the control. It didn't happen at all. It didn't happen the whole time. The buyers, institutional buyers, stayed here. They wanted to buy only at this price, and then um, sellers, institutional sellers, are ready to sell more at this price. Neither of them take over the other place people's spot. What happens to then? The market just, it doesn't matter. It goes close, like doesn't matter whatever happens. It's just manipulation. Market did not break out at all. Okay, that's why this strategy is not only going to help you to find the good entries on a trending market, and then there's a movement. Also, look at these ones. Okay, so like I told you, look at those. When the price moved down, the shift happened. You see the red to green, then the market shifted. So those are things when I say the green line should become red line. Exactly, these are example here. Anyway, so let's look at with the price how you could trade. So like I said, when we say the shift opposite happens right here, the green lines become red line to go down, and then red become green, then the stairs there, that's it. So once from here, you can see whatever the price action here doesn't really matter, because it didn't cross the bottom institutional buying interest, it didn't cross the top institutional selling interest. This is more than enough to help you, to tell you market is going to be sideways until it crosses top boundary and the bottom boundary. Wait and do not trade. As simple as that. All right. So again, so we have our customers who have traded or practiced more and more. Then you will know it's how much it's a game changer for once you try the liquidity, institutional liquid trading. You will never be trade without it, because you will start seeing things differently, completely differently. That's why it's very much important. Okay, so like I said, stop looking at the chart patterns and the historic price movements. Focus on level 2 market depth, level 2 institutional liquidity, and then learn to read how the market auction process shifting through the mirror, through the glass of liquidity zones, the NinjaTrader indicator. And also, once you practice enough what we teach with the videos and training, you'll be able to detect the move before it's really too late. Before it's really too late. Once you start shifting the when this red becomes green, green becomes red, control is shifting, you'll be able to enter the trade immediately. So that's the power of learning with the system. That's why we developed complete system in institutional trading. We have the videos on how to find the breakout on the uptrend, how to find the breakout on a downtrend, what to wait for, how not to take the high risk. All those things we have documented. Okay, let's next move to the most important other topic, stop loss. This is most underrated section in the trading. A lot of the times new traders focus on, I want the entry, I want the signal, I want the strategy to enter. Focus on the entry way too much, forget the importance of the stop loss. Why? Your stop loss is the one behind your loss. Don't forget, your stop loss is the reason behind your loss. That means if you don't control your losses, if you don't know what is a perfect place to keep your stop loss, you failed already. One bad trade could wipe out all the gains from even 10, 20 trades. Trust me on this one. That's why stop loss, your risk much more, but that's why we focus on those things. That's why we develop something called how to protect it. So we call it as hiding your stop behind the wall. Again, I'm saying we will teach the strategy how to hide your stop behind the liquidity wall. So that's what we want to focus on. You got to protect your stop to protect your trade. How? You got to hide your stop behind the liquidity wall. What do I mean by that? Okay, what do I mean by that? When I say the liquidity, I'm talking about these are all the walls. That means there's a lot of strong buyers in these green lines, isn't it? That means anytime you enter, don't enter anywhere here. Why? These are all unprotected area. That means there are no wall. Even if you have to wait till the prices come down close to the wall, so you can keep your stop below the wall. You need to hide your stop behind the liquidity wall. Why? If at all the price is going to get to your stop to stop you out, they need to go through this wall. They need to take. There are hundreds of thousands of orders sitting here by orders. They need to go through those buy orders, those wall, break that wall to get to your stop. That's why you can see a lot of the time when the price comes to that level, it'll bounce back because there's the interest. These orders, strongest buy orders, will push the back up. That's why you have to learn to wait till the price comes to that level, the wall, and then once you enter the trade, make sure you hide your stop behind the liquidity wall. So this is where your stops should go. Okay, you can tell this is where your stop should go. This is the most important part because most of the time, if you enter anywhere if you place your stop, you most likely going to get stopped out. That's very, very clear because we talked about this thing. This range between the strong buying interest versus strong selling interest is called liquidity volatility range. Anytime wherever you enter here, wherever you place a stop here, you are exposed to the hunting, or it's going to get hunted. That's something very much important. All right. So like I said, same liquidity zone, same institutional liquidity is going to help you to protect your stop because it's going to show you the wall, liquidity wall, where you can hide your stop. Okay, that's why. So that's most important reason. There is no other strategy. There is no other trading strategy provides a safest place to protect your stop, and make sure you hide your stop loss behind the strong liquidity, and then make sure you don't take the trade anywhere. Wait till the price come back to near that level and then start bouncing. This way you are keeping the same stop. Since you are waited till price come close, you are able to take the low risk trades. That means stop loss is very close. You're entering the trade very close to your stop loss. Small, I won't say no, that will be, all trades will have risk. Your goal is to find a trade with a minimal risk. That's the whole idea behind like a low risk trading. Here is the beauty. If you practice and then enough to learn how to enter the trades with a low risk, that means even if you are off, you will be afford to lose, take a small bet more and then maximize the gain a lot. So that means you'll be able to bet more because you are trying to focus on how to lose less, because you got to make a bet. You got to make a bet in the market, and then you cannot make a huge risk and lose one trade, wipe out all the gains that you had. Don't do that. Okay, like I said, small risk will help you to bet more and more trades, more and more opportunities. Okay, so liquidity, one of the some of the strategies we talk about will teach you when you join the program is liquidity sweeps and rejection strategies are designed to enter the trades near stop losses. Okay, so that's why stop loss is very much important. Let's move to the third important part, minimizing the stop loss, and also you got to maximize the gain because exit is most important part. You need to know how to exit when the trade is working to maximize it. When the trade is not working, how do you enter with the minimal loss, right? So both, it applies to both. So that's why it's very much important. The way you enter is important, and then stop loss is important. But out of once you're in the trade, your focus is all on the exit, on the trade management. How can you maximize it? How can you stay in the trade longer, as long as the momentum continues, not to get deceived by the price manipulations or pullbacks, anything. So a lot of times people just looking at the price action, pullback, opposite time, they will exit, and then market continues much longer. They'll get really frustrated. Oh my God, I should have stayed in the trade longer. Why? Because they're looking at the just price action. They're not looking at the liquidity. They're not looking at the liquidity. That is the main reason. Okay. So let's look at the same reason here. Like I said, the whole time when you find the market is like moving like a ladder approach, stair approach. Okay. Uh, Moment you see it's not moving anymore, it's like it's just coming to the same level. That means market from the trend, it started going sideways. That means anytime the price goes to top edge, like where the sellers are there, you should exit. That is the best possible way to maximize your trade. All right, best possibility to maximize trade. Watch the liquidity. Just watch those liquidity lines to see the trend. Once it's keep on extending. Okay, so actually, you know what? I think let me show you the same chart live, so that what happened this after. All right. Okay, this is the chart I took it from. Okay, I wanted to give you a little bit of background. Okay, so right, so okay, let's remove this. Okay, so do you see this one? Price moved, right? And I want to look at what happened after that. What happened after that? There was one more move as well, and then when did it? When do you think the reversal happened? When do you think the reversal happened? Now sellers not going up. Now look at this. Buyers are losing. First time the reverse opposite trade happened right here. The sellers was broken out, opposite liquidity. Then market went sideways. This is where you enter the short trade, the opposite trade. That's why this system is going to give you much better opportunity on finding the range, finding the long, finding the short, as well as the perfect reversal. Perfect reversal. That's very much important. Okay, so same thing. Every time you wanted to maximize your trade, you can see sellers are like and then that means this is where the sellers don't want to go down anymore. So that means anytime the opposite side, you can find the better exit. Once they stop seeing the lowering ceiling, it goes straight on sideways, the move is over. You'll be able to find better ways. This is a better way to exit at the maximum possible way to get the maximum profitability. Okay, so like I said, perfect your exit, because you do not, with this strategy, you do not need to stick with a random one or two or that kind of crap anymore, because you are going to stay in the trade as long as the market is going to trend, irrespective of the price action, irrespective of the pullbacks, irrespective of the manipulation. Because you'll be trained to ignore the price action, just look at the liquidity shift. That's going to help you to stay in that longer. Sometimes you will never know. Sometimes the move goes much farther. So that means you don't have to settle with 1 or 2 hour. Cash a full move in the market, including is it 1 hour or 20 hour, doesn't really matter. You should be able to stay in the trade much longer. Okay, but as long as you are ignoring the price action manipulation, just focus on the liquidity alone is going to help you make that shift. Okay, so I can show you a lot of things, but I wanted to give you the power of the system where you'll be able to find the entry, stop loss, and exit with the system much more clarity. But you got to practice. You got to practice more. You got to make some mistakes, analyze some mistakes, and then always you can reach out to us. What did I do wrong? What did I didn't say? You can always help you. So I can, by looking at those shift, we looked at the shift. Remember that we looked at the control shift. So likewise, these are the opportunities you should be able to find with a system of like liquidity. Just looking, because right now I have the price action much confused, but once we turn off the price, just look at liquidity, you'll be able to see all those opportunities to find the clear liquidity type of breakouts. Okay, so I can show you examples from every single day, because there are systems that work someday, that doesn't work someday, but with our system I can find you the trades every single day. Unless, I don't think we ever had recently all day was sideways. There are 1 or 2 opportunities almost like every single day for such a long time. So you'll be able to trade purely based on, okay, so to give a little bit of things, what I'm saying is that this level, you can see the strongest selling level, right? So you can see once the price broke out, it came back to the strongest liquidity and then starts turning. That means now buying interest is not here, buying interest is moved. So we can see institutional orders are here, price moved, we can enter. but that no point in time, you can trail the stops. You'll be able to see the uh, trail the stops. Just the business liquidity itself is going to help you stay in the trade. Okay, so I can show you more and more examples, but you can watch live examples on YouTube channel. That's the beauty about. We record a lot of videos on how to find those things, how to record it, how we read, how we trade, how we exit. There are a lot of videos there, but you don't have to take it from my words, what we say, because our customers' words speaks out more than what we say. Because the system, you need to have this better system, better learning process. Also, we have helped a lot of traders who struggled for years, not just months, they who have struggled for years. Once they are able to say liquidity zones is a must have, because one, it will change your trading in a positive way, but it's not overnight, but it's very reliable. Once you learn, practice, it's going to change your trading forever, that's for sure. We have seen um, uh, faster progress with the traders who know a little bit of supply and demand strategies or breakout trades, a little bit of experience on those, because transitioning from those to our strategy is much faster and easier compared to if you are a very beginner, you might struggle more. But if you have some sort of experience, some sort of knowledge on supply and demand and breakout trades, this is be much easier, because we'll shift you from price action based breakouts into liquidity based breakout, and then we'll focus you on how to be patient, wait till the price come to liquidity level, and then bounce. Those sort of things we help you understand anyway. But to trade this particular, you need to have NinjaTrader, okay, and also you need to upgrade your market data feed to level 2 market data, because by default all the traders have only level 1. You need level 2 market data feed.